All the way down. They're bleeding it right down to half a minute. Second and goal. Baldwin sets up on the left. Play clock at 5.
Those of you that watch the NFL will recognize this clip instantly. This was the 2015 Super Bowl, and what you're seeing has been dubbed the worst play call in Super Bowl history. With about 20 seconds left on the clock and with the ball on the 1 yard line, the Seattle Seahawks chose to throw the ball rather than to run it.
Pass is intercepted at the goal by Malcolm Butler.
The pass was intercepted and the Seahawks missed their chance of winning the Super Bowl, instead giving Tom Brady yet another championship ring. Immediately, the reaction from fans was that of complete shock. People were asking, why did they throw the ball?
I was rooting for you! We were all rooting for you! How dare you!
The newspapers were even criticizing the call. Without a doubt, people would be expecting that Pete Carroll would look back on this decision as one of the worst ones that he has ever made in his life. But what has all of this got to do with our trading? Well, let me ask you a quick question. And if you want to play along properly, you may even want to pause the video and really think through your answer. Maybe even leave a comment down below to really commit to this. I'd be interested to read what you put. So what I want you to do is, I want you to think about the best trading decision you ever made. Okay? What trade was it that you think you made the best decision that you've ever made in the markets? And then on the other hand, I want you to also think about the opposite of that. What was the worst trading decision you ever made? Which trade was it that you feel you made your absolute worst trading decision ever? I really hope that you've left a comment down below, and if you did, then don't delete it or edit it afterwards. Really commit to that answer. I'll be having a look through. So let's go back to Pete Carroll and the Seahawks. They had one of the best running backs in the whole league. The critics made it very clear that choosing to run in that situation was a no-brainer, and going against that and choosing to pass, well, that just defied logic. But was that actually the case? Well, by taking a more logical, computational look at the play, it's actually been revealed that maybe the call wasn't so bad after all. Brian Burke from Slate.com used win probability calculations and ran simulations of the game thousands of times from that play onwards. He found that the win probability from passing was 85%, and the win probability from running was 77%. Now, that's not a huge difference really, relatively speaking. And Benjamin Morris on 538 also calculated that the difference between the two plays under worst assumptions was 0.3 percentage points in favor of running, and under best assumptions was 3 percentage points in favor of passing. So it was actually in favor of the passing choice. But with either of these breakdowns, we're looking at real marginal differences in the win probability. Ultimately, the call to pass rather than to run was relatively equal. They both had quite similar probabilities of succeeding. So in that case, why is it that people are calling this the worst play call in history? Well, this is something that Annie Duke talks about in her book, Thinking in Bets. She puts it down to a term that they use in poker: resulting. Resulting explains our tendency to equate the quality of a decision with the quality of its outcome. And we see this all the time in trading. Now, be honest with me, a moment ago when I asked you about your best and worst trading decisions, was your worst decision linked with a bad outcome and your best decision linked with a good outcome? For most people, it would be. But let's think back to the Seattle Seahawks for a moment. You see, if that play had worked out as it was intended to, then people would have been claiming how it was an amazing call. It was an amazing decision to do that. And the Seahawks outsmarted Belichick. People were angry with the call and with the decision only because of the outcome, regardless of the fact that the probabilities of succeeding were just as high regardless of which call was made. So this means that if the probability of succeeding was 77%, we were just seeing the 23% chance of losing panning out. The problem is, as humans, we don't deal well with uncertainty, and we don't do a good job of really relating properly to probabilities. Instead, we want to close a feedback loop by linking an outcome to how good the actual decision was. If the result is bad, the decision was bad. If the result is good, the decision was good. But this doesn't take into account the inevitable uncertainty of the markets and the element of luck that plays a big part of what we do when we're trading. It pins everything on skill and nothing at all on luck. So let's go through a hypothetical situation. Let's say that you have two trades. One of them earns you a 5% return, 5% profit, and the other one loses you 1%. So there's a 6% difference in the returns that you make in these two trades. That's quite a big difference. Now, most people would look at these two trades and try to figure out what they can repeat from that 5% return trade again and again. They obviously did something right, and therefore they want to repeat it. Likewise, the losing trade wasn't good. The outcome wasn't good. What they did must have been wrong. So they're going to look at that trade and try not to do those things again. However, things might look very different if you actually look at what the decision-making process was to reach those outcomes. Like, what if the winning trade was just taken as a result of flipping a coin to decide the market direction? That's not a very good way of making a trading decision, is it? You're not going to say, okay, I'm going to flip a coin every time from now on because that works on that occasion. And what if the losing trade was part of a decision-making process that in that same situation would lead to a probability of winning of 77%? And when it does win, it would be a 5% return. Suddenly that losing trade actually looks pretty amazing, doesn't it? Even unrealistically good. Now, that's obviously a very extreme example, but the same is true for all of our trades. Too many people are replicating losing decision-making processes over and over again just because they've made some profits with it in the past, and they think that that proves that it must be correct. It's not the case. You can't say, well, I've made a profit from it, so it must work. Likewise, you can't abandon a decision-making process just because you've had a losing streak or some losing trades when it may have been a process that over the long term would be successful. You can't just say, well, I lost, so it can't work. That's not the case. You know, this is all heavily linked to things like hindsight bias and our tendency to look back on past outcomes and try to rationalize what led to that outcome happening and how we should have picked up on it in advance. But that's not what I want to get into in this video anyway. I think you get the point that I'm making. What I want to do is to firmly plant this thought and this overall understanding into your mind. I want you to stop judging your trades solely based on the outcome of that trade. Don't fall into the trap of resulting. You might be on a losing streak and actually have a system that's profitable over the long term. Your losing trades may have been due to something obscure that doesn't happen often, or it might just be the inevitable losing streak that you go through when things are based on probabilities. So instead of just scrapping things or making our judgment on the outcomes, we need to break down every single trade, whether it's a profitable trade or a losing trade, and figure out what was right or wrong about the decision-making process. We need to put everything into perspective so we can actually learn from the things that are possible to learn from, not the elements of it that was down to luck. So with that in mind, we need to be more objective about it all and be more honest about which elements of it were down to luck and which parts were down to skill. And I know it can hurt our ego sometimes to accept that a good outcome was probably more luck than skill, but breaking things down in this way will help us to improve. So in the long run, that short-term hit on your ego is going to work out so much better for you. So for example, did an unexpected news release move the market heavily in your favor? In that case, maybe your massive profit that you had on a trade was actually mainly due to luck rather than skill. So is that trade distorting the data of how good your system actually is? Have you just been on the right side of news releases? Of course, on the other hand, it may be that you had some reason to believe that the news was going to happen in that particular way due to some sort of fundamental factor. And in that case, maybe that bit of insight that you had can be worked into your potential success rate since it was partly due to skill. But you need to be honest with yourself and not just claim that something was skill when it was actually down to luck. Although it is going to be impossible to remove the element of luck from our trading outcomes or our trading decisions, we at least want to remove the element of luck as much as possible from our estimations of how good our system or our skill level actually is. So guys, just some food for thought for you there, just something to consider with your future trading and analysing your previous trades. And in fact, with this information in mind, would your best or worst ever trading decisions change from what you thought it was earlier? Maybe it'll be that in future, you'll think that something is a good decision or a bad decision after the event regardless of what the end outcome was. And that's what I hope for you. So if you like this video, please do hit the thumbs up button. Don't forget to subscribe to the channel so you don't miss out on any of our future videos about trading the financial markets and plenty more. Leave a comment below, let me know your thoughts on this one, and I look forward to seeing you in the next video. Thanks for watching, see you soon.